Yes, Tim.
Okay, we are streaming. Thank you very much, and I appreciate you taking the time today, Manish. Manish Gupta, welcome to Meet the Gurus.
Thank you. Thank you very much.
Great. Well, appreciate you taking the time. As you know, and most people know now at this point, we are dedicated to Meet the Gurus to technology and business and entrepreneurship and all the where these converge. And these are short and focused discussions on a topic, and today's topic is about financial modeling. Obviously, you've had extensive experience in this area, so if you can first, I think the best thing to do would be if you can just first talk to us a little about your background, where you are located, and how you got to doing what you're doing.
Thank you very much for inviting me to this topic. As you said, yes, I do have an extensive experience in financial modeling. So, I am a qualified accountant from India, basically from Delhi, and now working in Myanmar as a CFO with True Hospitality. It's a hotel company. We have about 15 hotels in Myanmar. And I also consult and help the startups in their business planning, in financial modeling, in making up their numbers or helping them to analyze their financial things. So, financial as we know, as we are in the business of managing the finance, financial modeling is something like a very daily routine things for us as you are brushing the teeth, because we have to make financial decisions every single day, and without doing a proper modeling we cannot make the repeatable business and which are useful, right, for the business. So we have to forecast, we have to check the past records, we have to make projections for the 1 year out, 3 year out, 5 year out. So all this that is done through the financial modeling. So that's my experience with the financial modeling.
Yeah, and as most people who have been in the financial business or have had any exposure to it know, financial modeling is essentially telling a story about the company, right? It's telling a story about where the company is, where it's going, and if you understand the finance, you can actually understand where the business is and what it is. And often, as anyone who's seen any one of the television shows around the world about, Shark Tank or Dragon Den or whatever they're called, all know right away that if you don't understand the financials of your business, there will be very few, if any, investors who are interested in investing in it. And it probably demonstrates, I guess, to someone who's not even a finance person that you really don't understand your business. If you don't understand the numbers, you don't understand your business. That's a pretty fair statement. Wouldn't you agree?
Yeah, right. Absolutely. I was teaching a financial modeling, and normally the the similar example I use mostly for explaining the financial modeling is like a map. So it tells you where you are starting from, what are the journeys throughout the business that you are taking in 3 years time, 3 months time, 6 months time. So basically, it's a map which is going to tell you how you are starting, what are the paths that you have to cross around your journey, and what's the end goal, what's the and how you are going to reach the end, right? So that's the precisely is storytelling.
Right.
So financial modeling is not just only the numbers that you are presenting in a profit and loss statement and then that's done. It's more of a storytelling, how you are setting up the business, how you are
Right.
going to grow it, how you are going to reach the end
Right.
towards that. So if that's done, you understand numbers pretty much easier compared to just remembering the numbers, right? Because if
Sure.
you connect it with a story, then it's easy to remember.
And also, historically, obviously, people would write these things down on a spreadsheet. Of course, not pre-computers. They were actually physical, written spreadsheets. And so, many people wonder, well, why don't I just so-called hard code? Why don't I write a year one, year two type? I'm demonstrating with my fingers for those who are just listening. Year one, year two, year three. Why don't I put 100, 125, 150? And I'll sort of jump to the answer. You know this, obviously. It's because things change, and it's a dynamic world, and things you might
Yeah.
want to see. What if I in a hotel? What if I was to spend more money in advertising and generate more people coming to the hotel? What if we decided to put fruit in every room, and therefore the fruit is going to cost us some amount of money, and not only just the fruit, but moving the fruit into the room and it's purchasing it and all that kind of stuff. So it's a dynamic world. It's a dynamic business. Your business is dynamic. Presumably, all businesses are dynamic. Um, And so you
True.
need to model that out based on assumptions and what ifs. They're to say, things that are dynamic in your model.
True. And that name for that is scenario planning.
Correct.
So, for example, now we are doing in COVID-19, we have multiple scenarios playing out to our benefit or to our disadvantage. And specifically in Myanmar, we have other political instances as well. So, normally, it's not like once we do the financial modeling or budget for the whole year, we are going to sleep on it and then we just compare month by month. That's not the case. We have to adapt it to every single month. We see, okay, what's changing now, how our assumptions are changing. So if we have assumed that our revenues or our ADRs, prices are going to go up by 5% in October, how does that make change if we are not able to make 5%? Maybe we have to satisfy with no change at all. How does that impact our bottom line?
Right.
So if we hard code the numbers, then you are gonna do the financial modeling essentially every single month and spending on time on it, and you cannot make the quick decisions, right? So basically, it helps to understand, test out your assumptions, make the so that we can assess scenario one, scenario two, scenario three, what will happen, how much it's gonna affect our value, how
Hmm.
does it affect our bottom line and the growth potentials.
And when you build models, whether it's in Excel or Google Sheets or some other platform, you obviously want to centralize your assumptions, meaning you want to put them in a place where pretty much anyone who's never seen the model before could go in and say, and you could say to them, hey, just turn to page one or page two and look at the assumptions, and then we can, and if they modified the assumptions there, it wouldn't blow up the model. In other words, if you had 5% growth and they say 3% growth, and if you had the expenses are going to be this or that, and then they adjusted them, the model wouldn't suddenly fall apart.
Yeah, yeah, that's true. The best practice of making the financial model is essentially put all the assumptions in one sheet. I mean, normally we use the most common method. 90% of the financial modelers use Excel. There are some ready-made platforms nowadays where you can just plot in your numbers and then the financial models will be done. But the best, easiest way and the cheapest way is to do it financials in a spreadsheet.
Yeah.
And the way we structure the as a financial modeler, we create the assumption sheet separately, and then we create a input sheet. So whatever inputs we are going to have, and then there is a output, the final outcome, whatever we want to desire. So we start with different. If it's, let's say we are doing a three statement financial model,
Hmm.
so we're gonna look out the P&L, we're gonna look out the balance sheet and the cash flow, and then we have working towards them, ratio analysis, how we are estimating, and then we put the assumptions as well in one place. And normally they are like color coded and easy to read, so that in case anybody want to stress test our model or want to check our model, that what are the assumptions, because in modeling we have a lot of assumptions, right? Every single thing, because we are all talking about the future, so
Hmm.
expenses, revenues, how is the relationship, we all assume things. So
Hmm.
if we don't put the assumptions in one place, it's very hard to review and revisit them in the future.
Hmm.
So let's say in the you make a financial model now, 3 months out, you are going to review it. You don't know where what was the assumptions and how where else we use assumptions. So you have to use the color code to so that you know what was the input, what was the assumptions,
Hmm.
and then you can make sure that you are changing them or revisiting them all every time whenever you are updating your model, because
Hmm.
updating a model is essentially a part of making the model as well. So you have to update it every month or every quarter depending on what is the intensity of change in your industry or in your
Right.
business.
And as you were saying, I mean, the model, the nice part about it is, well, there are some components or some good ideas you might get from some out of the box models. Almost every business has nuances that are unique to it, whether it's in the hotel business or the manufacturing or in the software services sector. So it's really important for anyone who's using a model to understand how it works. Maybe not necessarily every cell, but to understand what it's doing. So before anyone really, because there are people who are listening to this who are doing financial spreading for large organizations. They're doing loans. They're making loans, or they're involved in the loan making process, or the loan underwriting, or the loan evaluations. And if they don't understand what the model is doing, just punching numbers in like a little monkey just puts in things in a sheet, it's not gonna the chance of it of it working and being effective is very low. So it's not. So if you're using a financial model, you really should fundamentally understand how it's built, where are the connections, and how they all fit together. Is that a good way of describing it?
Yeah, true. But usually for, because as you said, every business has different nuances. Even the same industry, businesses work differently. The models are quite different. The way we charge the prices, the way we have spending the money. For some people's, let's say for example, a very basic example of rent. Rent can be variable, can be flexible. So the ready-made financial models, the generalized financial models, are not the best way if you are doing it, because they're the very, if you're doing it for the first time, I highly recommend that you do a customized, not, don't use a ready-made financial model, because as you said, you don't know where the cell is linked towards the output, and you will be lost completely. So it's better to have a customized model starting from the scratch and thinking about everything from the basics. It all goes towards the basic.
Yeah, it
If you
sounds
want to
like.
use the
God, I'm
pre-made
sorry.
financial model, then there are a few things that you have to remember. One is look at the output. The first thing is the output sheet. What is it generating,
Hmm.
right? Then you will be able to understand, is it something that I want to see for me or not?
Right.
And then you need to trace back, how is it linked with the inputs, how the inputs are done. Do they have a variable percentage, or do they have a fixed key in? Means you have to calculate outside the excel and then key in the numbers, or they have a formula built in. So you have to understand the formula itself, because sometimes the financial modelers, the the ones who are creating the templates, they use quite complicated formulas, right? If and match, mix and match. If you are not an excel expert, you will be lost, you may get lost, right?
Right.
But in financial modeling, if you are making it from the scratch, you are tend to use the formula which you understand by yourself.
Right.
Even if you have to link the formula, you may link one by one, but that's okay, because you understand them, rather than using a VLOOKUP to pull in the numbers which are related, right? So it depends on what are your Excel skills. If you are expert, you can go ahead and use the pre-made models and customize based on your requirements. If you are not an Excel expert, I would suggest you use custom made. Start from the scratch, even though it may take time, but you are sure you're gonna get what you want.
Yeah. So I know you wanted to show us something, and you were going to give us a little bit of a high level as to how you look at models and how you present them. So just tell me when you're going to show your screen, and so those who are watching online can see what's going on.
Yeah, let me share the screen now. It will just be a very high level view of what is financial modeling and how is it connected. Can I share now?
Go ahead.
Okay. So the financial modeling is used differently in the business. So we use it different times. So in the main phases of doing the financial modeling in any kind of business, if you consider business tree as a tree, the first thing we have to do is the business model. So that's the basic of the business. But after that, there are multiple phases where we use financial modeling. So we use in pricing decisions and costing decisions. We make the prices of our goods. We calculate the unit economics. So we are using the financial modeling in that respect, even though it may be very simple, but it's there. Then normally for growing the business, we have to invest into the business. We have to buy new equipments, we are going into the new product launch. We are doing acquiring companies. So we have to do a capital budgeting and investment decisions, for which we again need a financial model to tell us whether this investment is worthwhile or not. Then we are doing the operational spending, right? Decisions making, where we are saying that, okay, do we make in-house or do we outsource the business? Do we put more on variable cost, or we should make our cost fixed? What kind of capacity we are going to plan? So those are all the decisions that you normally take while you are operating the business. And then managing the business, again, we have to do the performance reporting, business planning and forecasting for the next year. So again, financial modeling is going to help you to draw out your plans, story tell your business, how is it going to affect in the next 2 years, 3 years, 5 years, and then measure your actual performance against the budget as well. So you have to be really you have to use that kind of financial model. So there are different type of financial models we use for everything. And then the lastly, there are usually used valuation models, which we are now taking that, okay, what's the value generated for the shareholders or for the investors by the business. So there are mainly three type of common use of financial models. One is we are generating a three statements financial statements, which is include the profit and loss statement, includes balance sheet, includes cash flow, which we are generating for the business for future. So we are doing monthly forecasting for the next 12 months, 6 months, and we are doing 12 months budgeting for the next 1 year, 2 years. So that helps the business to understand how the value is being created, what the assets will be like, what are the future things that we are going to use. Then there are discounted cash flow models, which are mostly used for project evaluations and understanding whether our investments are going to make sense, whether it will improve our shareholders' wealth or not. Then the last is the merger and acquisition model. So these are combination of the prior two models, the statement financial model and discounted cash flow, where we are evaluating whether the company we are acquiring has a value or not. So we use discounted cash flow, and then we combine and we look at the financial statements to see what is the value that is going to generate, how our synergies will impact the consolidated entity if we are doing a merger or we are acquiring any company. So these are the mostly the high level of the financial model that we use in business world. If you talk to any startup or any business, those are the general ones. But there are other smaller models which are like pricing model, revenue models, which are built upon in these models. So they are not different from these. They are just basics of the three main models.
And
So that's the
when you're looking at
sorry.
this, just let me ask you the question. When you're looking at this, obviously, the financial models, the profit and loss statement, the balance sheet, and the cash flows. Can you describe in high level at this moment? Maybe you're going to drive into that in a second. This is what each one does overall.
Yeah. So the profit and loss statements give you an overview of what was your operation like, what how did the business generate this, how much sales it was generated, how much was the expenses, and what's the profit that the business is taking home. While the balance sheet is going to give you a snapshot at a single point of time. So while the profit and loss statement is for a period, let's say for a month, for 6 months, for 1 year, balance sheet is in the moment. So at this particular point of time, which is usually the calendar year or which financial year ending, it's going to tell you what are the assets of the business, what are the liabilities, what we own and what we owe to the outsider, whether we owe to the shareholders, whether we owe to the financial institutions as a debt from the banks, or we owe to our creditors, suppliers. So that's the balance sheet. While these two will gonna tell you how did we make profit, how we stand in the moment. The cash flow is the most important statement of the three, which is gonna tell you how you have generated the cash, how you have invested the cash for your future business, and what are the returns that you are giving back to your shareholders, whether it's your debt shareholders or whether it's your equity shareholders. So how much interest you are paying, how you are using that money basically. So cash flow is going to give you a snapshot of the cash, real cash. What was it? How was it in the beginning? How does it? How much did you generate it? How much did you spend on your growth? And how much did you return to your financing activities? Maybe you repay your debt or pay a dividend or buy back some shares, whatever you did. So that's the cash flow. So because the cash flow is one of the major aspect of doing the valuations and evaluating how the business is doing. The cash flow comes out of the two business model, two financial statements, the profit and loss statement and balance sheet.
That's
So that's
very
the cash flow.
Yeah, and it's kind of interesting because most people are unfamiliar with it, but it is true, as you said, that it's probably the most important of the statements. And at the same time, most people are if they may know what a balance sheet is. They know, for example, personally, do they own a car? Do they own a house? Do they rent? And all their personal assets, and maybe they owe some money to friends and family, or a bank, or credit cards, etc. And then they would feel they'd have a good sense of what their worth is. Not as a person, of course, but as a their
Yeah,
financial
business.
worth.
Yeah.
And then they would know, oh, we've got to set a budget, a personal budget for this month or
Mm.
this year. How much are we going to be able to spend? Where are we going to be able to go on vacation? Where our income and then where our savings are. But most people don't then take a look at personally on a personal level. You know, what are the categories of the spend? What was the
Mm.
real cash flow? Sometimes there's interest you pay on a loan, and there's also principal you pay back. So all of these things fit together, so that you really have a good picture. And to understand each of these is to really understand in a business context, and also probably on a personal context, where you stand financially.
Yeah, I mean, I do my own cash. I mean, I do cash budget for both my business, which is we are doing on a monthly basis, and I do cash budget for my own personal expenses also, so that I know what type of income I'm getting, in when I'm going to get the cash, when do I have to pay the school fees, when do I have to pay the rent, when do I have to maybe accumulate the money for any spend any travel that I'm going to take. So it helps me to understand and plan my own future, that how I'm going to use the cash, how I'm generating it, am I getting any other cash, or can I do I need to get any other cash. Basically, it helps to have, even for a personal professional, even though they may not be in a business, but it helps in their personal financing actually.
Yeah, it's absolutely true, and it doesn't require a sophisticated model, but it certainly does. If anyone, everyone's seen all these things about credit, improve your credit, etc. But one of
Yeah,
the
yeah.
simplest ways to improve your credit is to understand your financial situation. And again, going back to that kind of Shark Tank model, if you don't understand the numbers in your business or the business you work for, then you're clearly not going to be able to make any rational decisions, and you might be wondering, why am I getting a different outcome when I am guessing? Well, you're getting a different outcome because you're guessing, and you're not having a real clear picture. Even if you have a change in your point of view, you need to be able to have that kind of financial model in front of you.
True. Yes, that's right.
Yeah. So go ahead,
Uh,
continue. I'm sorry.
So moving on, yeah, moving on to this. So these are the three common financial model that we use in the business. Then the question starts with how do we get started with the financial model? So the first thing is we have to really collect the data for creating the financial model. So the data comes from two sides. One is internal data, which is mostly the historical data, that what is the financial what have been the revenues, what has been the expenses, and how the expenses has been related to the profits, right? So that's called financial data. How much cash you are generating, how much you are spending. So you may want to look at least last 6 months, to be sure that you are taking the recent trends. You don't need to go for last 5 years, because normally the business has been changing super fast nowadays, and the environment is changing. So you don't need to go very long in the past, but you don't need to get at least 6 months of data, so that you know what how your business is being generated. Then there are some non-financial data, which means your customer acquisition, your goodwill, your customer surveys, website visits, the segmentation of the customers, the profiling of the customers, and how the conversion rate has been happening. What is the acquisition cost? So those are built not those are kind of financial and non-financial data, which is qualitative data for your business. So you need to have that data in your hands, even though your business may be 6 months old, but you need to get what you get first. So as a starting point, right? So that's the data, and then you can use some external data to support your financial model, which is kind like you may get the economy data, you may get the future GDP data, you may get the employment data, the demand, the consumption, the price inflation. So those are the data which we use usually for making the projections as a basis of our assumptions. And those are you can get from the government websites, which are usually free to provide. You just have to know how to download those data, or you can use professional research reports. So there are tons of research companies who are going to provide you the data. You may have to pay that to get the market size, to get the number of customers, to get the projections from the research companies. So you may have to pay for that, but that's the data that we use. So we start with internal data, we go to see what the government data is, and then we use the if we need to use, then we use the professionally research depots. And then you can also collect some data by yourself, doing some surveys in house, doing some market research in house, by talking to your potential customers, maybe 10 or 20 of them, so that you can understand what will be the pickup ratio, what will be the capture ratio, how the business is done, how many customers are liking your project. So it gives more credibility to the financial model if it's backed by some real data. Otherwise, you just have to you are just making the numbers out of thin air, which is not really credible. So that's the data. And then let's look at the steps in building the financial model. So the basic steps is, the first thing is for solving any problem, because financial models are really the decision making models which you are using to solve any kind of problem. So the first thing when we are making a decision is to identify that particular problem, what that we need to solve. Whether we want to know how much will be our business in the next 6 months, that's one problem that we want to solve. How much is the value of our business, that's another problem to solve. So every problem requires different type of financial model. So you have to understand first, what is my problem that my financial model is going to solve. And then you will look at how your how the problem's answer will look like. What is the answer? So you may not know the answer now, but you may have to build up output. What you really want? You want a value number, you want a price, you want profitability, you want the IRR. What do you want really? And then it can be a dashboard, it can be a decision table, and then you will start to gather the data for your financial model, which is you will, if you need to get the financial data from the other party, then you need to tell them, you need to give them a due date, give them the input sheets. Because if you are collecting the data, you need to make sure that you are collecting the data in the same format as your input. Otherwise you have to convert, and it's going to waste your time, and you may lose the data itself. uh, so these are the steps that you are going to use. And then once you have collected the data, then the next step really is to structure the financial model. So the structure, you have to separate the inputs, calculations, and outputs. So what's the end result? How is it calculated, the ratios, and how is it linked to the input? And then create the input and assumption sheet separately, so that it's clear and segmented. You're not going to mix it. You may use the different sheets for that, but you need to make sure that you are using the column for the same reason all throughout the model. So you have to be consistent. So if column A is for description, column B is for, let's say, month one, column C is for month two, then you have to use that same structure all throughout the same sheet. Otherwise, when you are copying the formula, you may do the error of linking, let's say, January with the February, or February with the March. So you want to avoid that kind of situation. And another best practice is use the one formula for one cell. Don't try to be over smart with the financial models, because by adding a lot of formula in the cell. So I have seen financial models which are built in if error, and then if is also nested within a lot of ifs, right? So you don't want to use that kind of financial modeling, or you don't want to use like 10 different calculations added into one cell. Rather than break down the model into different rows, and then add it up together. So that's the easier way. So use one formula in one cell. And then you can use, if you're using multiple worksheets, let's say you are going to have one sheet for pricing model, one for manning, one for depreciation, one for working capital, one for any other purpose, or debt schedule. So means you need to have a master sheet which is have hyperlinking the sheet to the worksheets within the model, so that navigation it becomes easy. Otherwise, when you have multiple sheets, it's gonna get a lot of confusion, and it's difficult to navigate. Then use color coding for inputs and formulas and outputs. So you have to identify, maybe yellow is my input, blank, or maybe blue is my formula, and red is my output. So you can use any color, so that you know what the color code is, and you are not accidentally overwriting the formulas. You can name the cells, so that it's easy to identify in the formula. For example, if we have a price in a cell, you can name that cell as a price. The benefit of this, when you are using this cell in the calculations, it will say price into quantity. So that you know that, okay, my revenue is price into quantity. instead of saying C1 into D1, right? Rather than using the cell name, name the cells, and then you will be able to use them all throughout the model without need to fixing it, or without need to linking it again and again. Then you may want to use instructions, so that how to do the data validation, uh, so that you can make sure that the date is date, numbers is number, dollars is currency signs are done there properly, so that you are not making any mistakes in inputs. Then you need to have an error checking sheet, so that, like for example, a very basic example of error checking is balance sheet totals need to match. So total of assets, total of liabilities need to match. For a cash flow, the beginning cash plus the flow need to match with the outflow, which you can link from the balance sheet. So you have different ways of making sure that there are no errors in the financial model. And you have to make the error sheet separate, so that you can check whether these are good enough. Then the another best practice is to use dynamic assumptions. Means you have to make sure that the assumptions are changing in the assumption sheet as you are changing the financial models. Because sometimes we have to write down a summary of the financial of the assumptions which we are building up, so that we can update them all. Otherwise, your financial model and your assumptions written in somewhere else will not match. And don't use the hard coded calculations. Don't use in the cell 5 multiply by 10. Rather than that, puts 5 in one cell, 10 in another cell, and then use the formula 5, that's 5 into 10, rather than instead of putting into the cells that 5 into 10, because you don't know, you will not remember that you have hard coded, and it's not going to change dynamically when you are changing the 5 in one number in one cell. It will not affect the other cells because you are not using the link formulas. So that's the best practice on the financial models. The other common things, very basic things, are you may use comma for thousands, or comma for millions, as you like. You need to specify what is the currency you are using, and make sure that you are using the percentage for percentage columns. You may need a dedicated unit column for multi-unit or currency models, so that you can show the conversion how is it happening. Otherwise, you have to use the same cell for multiplying the currency, and that may create errors in the financial model. And use clear headings with the unit. So what is it? It is liter, is it kilograms, is it grams, how is it when you are making the recipe? So you need to specify what it is exactly. So that's the financial modeling. Then the last step in the financial modeling is really to spot your errors. So you have to understand there are different type of errors. One is logical error, which is your assumption may not be correct. This is not easy to find. The only way to find is to do the ratio analysis and to see whether your number makes sense or not, whether it's come near to what you expected originally or not. If there is a large gap, you may want to recheck your assumptions. Price and cost estimates may go wrong, right? So you may take a wrong estimate of how much price you are going to charge, how the cost will increase. Again, you will not be able to spot that error by looking at the model, but by looking at the results. Missing facts, you may miss the facts. Then there are some technical errors which can be avoidable by using the best practice which I described earlier. By those technical errors can be formula error, you are linking to a wrong file. So normally the way I do is whenever I finish certain sections, so financial models are built into section, right? Revenue, cost, assets, liabilities, debt schedule, cash flow. So whenever you are finishing one section, I highly encourage you go into the audit mode of the Excel. So there is a option in Excel to antecedent and check the precedent, so that you can check the formula errors. So the formula is linking to the right cell. There is no formula. There is no error in the formula. So you have to do that section by section. So you are making sure as you are building up the model is error free, especially the linking and the formula. Otherwise, once you finish the model, it's late already. It's gonna take a long time, more than building the model to check the errors, and that has happened with me multiple times. I make the model, balance sheet doesn't tally, then I spend more time in checking where the balance sheet go wrong, compared, and that time is sometimes more than what I used to create the model itself. But that's how I learned the hard way. So I suggest you check the formulas, check the linkings, double counting, um, those errors, and then the easy way to check is to have a sanity check, whether the number is making sense. So you may have an idea when you are making a financial model, how does my numbers gonna look like? What is my expected profit? If you are expecting 100,000 and the result comes 1 million, definitely is wrong. So you have to have some sanity checks, and if the results are as the expected, and then you can create checksums to ensure nothing is omitted. For example, the balance sheet are matching or not, right? So those are the basic things which I wanted to share with you on the best practices in financial modeling.
It's fantastic. It's actually very detailed and very clear, and I think that most people don't have that kind of perspective, and they don't know what's going on in a model. And I've done financial modeling for my whole career for many years, and you get deep into all the things you've described, and you realize it's almost like you walk down a maze and you realize, oh, I made a mistake, but you hadn't planned it,
Yeah,
right? You sort of walk down, and then you've spent so much time building this model, and you're so convinced by it. But at the end of the day, you've got so many errors, and you can't even figure out where they are because you haven't done the kind of very structured, methodical approach to financial modeling. And obviously, I've began my career in financial modeling real estate and large multi-$100 million office towers. And, that was back in the day when there really wasn't even Excel. There was, Lotus 123, and then there were packages. In fact, just what you're describing, there was a company in New York where I was based that had a DOS based program that you literally put in all the formulas, and then you realized, oh well, it doesn't really do this. It did a very good example in this case of what's called rent roll, but
yeah,
but at the same time you realize you can build that entire model today with
mm-hmm.
dashboards and all the kind of things in Excel, right?
Yeah, yeah,
And with all the overlays and Visual Basic and all the old tools, you can build dashboards that are gorgeous. You can build them interactively. We did a webinar and also kind of Meet the Gurus program where someone dynamically, is just an example, using Power BI on top of Excel, was able to show you in real time the Olympic scores, the go out to the Wikipedia to find the country history of those, and in real time pump out information on a dashboard, which is using Excel as well. So
wow, yeah.
the power is pretty much unlimited. It's one of the most powerful programs, and I obviously as
See,
you,
the limitation is your imagination. What you can imagine,
yes,
you will be able to build it. So
yep,
you are limited by your imagination really now.
that's right. And it's clarifying everything. If you're running a personal flower shop, if you're doing mortgage underwriting, whatever your financial spreading is, if you do not understand the numbers, you do not understand the business. Actually, go back to your just one of the last points I would like to cover is this idea of metrics. If you find out that you're in a business, and I don't know the hotel business at all, but if you're in a business and you say, look at how many revenues we're going to earn, and we have 3 people earning those revenues, and you realize it's, I don't know, make up a number, $1 million per person, per employee. And then you look at the industry data and says, well, the average of the best companies in this business make $250,000 in revenues per employee. Then you're probably unrealistic. I mean, that's probably, as you were saying before, you've got to look at some industry data. Either you've just reinvented, let's say, hoteling, or software engineering or something, or which is possible, of course, and you better have good support for that, or you're wrong, right? Or your
Yeah,
data, you're just making assumptions that are unrealistic. And someone, in the Shark Tank world, Mark Cuban will point that out right in a second because he or she has lived those numbers, and they know. I could almost guarantee you that Mark Cuban can tell you how much per person he earns in every basketball game that people come to in his teams. I mean, I can
yeah,
guarantee
yeah.
you he knows how much, and he knows how many people on average, and so these are the kind of things that it may sound like you need to be an accountant to think this way. No, you need to be you need to be in a business. That's all you need to be.
You just need to question the things. Sometimes the businesses are showing the very classic example is they show a hockey stick approach, right? When they are projecting the growth, first year they're gonna say okay 5%, next year 50%, or 50% growth overall over my period of next 5 years. So your projection gonna skyrocket, but are they realistic?
Right.
As the numbers grow, the growth over the past month goes slower, 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 slower.
Right.
So you have to really see, are you using the same growth numbers for the whole entire period? Is it really sustainable or not?
Mm-hmm.
At that point of time, and with that kind of volume, do you have enough resources for that?
Yep. Yeah, it's great because people make projections all the time and they realize that that the numbers just, yeah, and then also it's sort of like the sniff test, as you were saying at the end. Is it real? Is it realistic? Can you sit back and realistically think? I mean, we all love to see our businesses flourish and the costs stay very low, and but things change, and so the model is really a central kind of, if you will, brain or nervous system to the business, and without
Yeah,
that, it's very difficult to really succeed.
yeah, true. Absolutely.
Manish Gupta, thank you very much for taking the time. We really appreciate it. We'll see you again on another Meet the Gurus, and we'll see your courses on our system.
Yeah, thank you very much for inviting me to this. I'm excited. Thank
See you
you.
again next time.